Today, we're diving deep into an overlooked opportunity that could be a significant winner in the coming weeks. BGC Group, ticker BGC. This financial infrastructure powerhouse is in the midst of a dramatic structural re-rating, poised to benefit massively from shifting market dynamics, upcoming Fed volatility, and its audacious play to disrupt Wall Street's most lucrative monopolies. This is a high-conviction play stock with explosive catalysts on the horizon. Let's set the stage with the latest market signals. We've seen a clear risk on turnaround across global markets. Geopolitical tensions have eased, helping calm inflation fears. Oil prices dropped sharply, with WTI crude falling to around $85 a barrel. Treasury yields also eased, with the 10-year dropping to 4.45%. The Russell 2000, representing small-cap stocks, outperformed significantly, up 3% to 3.9% last week. This signals improving market breadth and renewed risk appetite beyond mega-cap tech. However, the market remains event-sensitive with the FOMC meeting next week, specifically June 16th and 17th. The Fed's updated dot plot and Chairwoman's press conference will be critical catalysts. This environment of improving breadth, financial sector strength, and impending rate volatility makes our featured stock, BGC Group, incredibly relevant. Let's turn our attention to BGC Group, ticker BGC, which we're labeling the Wall Street Toll Road. BGC is a leading global brokerage and financial technology company. They act as a critical intermediary in wholesale financial markets, facilitating trading for major banks, hedge funds, and investment banks. This isn't a traditional bank. It's a toll road for institutional trading activity in fixed income, foreign exchange, equities, energy, and commodities. BGC is successfully transitioning from a lower-margin voice broker to a high-margin, tech-driven electronic exchange operator. A major catalyst for BGC is the FMX platform, its electronic ecosystem for cash treasuries, FX, and interest rate futures. FMX is actively gaining market share. In Q1 2026, FMX U.S. Treasuries' average daily volume grew 51% year-over-year to a record $89.7 billion. FMX has captured a staggering 41% market share in central limit order book cash treasuries, chipping away at the historical dominance of CME's brokerage. FMX Futures, which launched SOFR futures in late 2024 and Treasury futures in mid-2025, is scaling exponentially, with SOFR futures ADV exceeding 39,000 contracts in Q1 2026. This proves institutional clients are migrating to BGC's alternative exchange. To build FMX, BGC avoided the chicken and egg liquidity problem by selling minority equity stakes to 10 of the world's largest investment banks and market makers, including JPMorgan, Goldman Sachs, and Citadel Securities. These top liquidity providers are now incentivized to route massive order flows to FMX, creating a permanent, structural volume floor for BGC. BGC also circumvented CME's clearinghouse advantage by partnering with the London clearinghouse, LCH. This allows institutions to cross-margin their massive OTC swap positions against their FMX futures contracts, eliminating billions in redundant collateral requirements. This makes trading on BGC structurally cheaper than trading on CME. Historically, BGC traded at low valuation multiples due to its voice brokerage business. However, as revenue shifts heavily toward its fully electronic FMX and FMX platforms, BGC is primed for multiple expansion, re-rating from a low multiple broker to a high multiple electronic exchange. Shifting to the charts, BGC is in a powerful, undeniable uptrend. Following a long consolidation, the stock staged a massive breakout from the $9 level. It has surged to recent highs of $11.91. Currently, BGC is digesting those gains, trading around $11.85. The Relative Strength Index, or ASI, is at 68. This is elevated and approaching overbought territory, confirming strong bullish momentum. It also suggests a brief period of consolidation may occur before the next leg higher. The volume dynamics are spectacularly bullish. We're seeing 89% buyers versus just 11% sellers. This indicates aggressive, sustained institutional accumulation in the stock. The point of control is anchored deep below at $9.05, a strong foundation. BGC has already cleared the major breakout level of $11.49. Our trading plan is clear. Accumulate on any minor pullbacks. Look for entry opportunities in the $11 to $11.2 moving average support zones. Let's break down BGC's fundamental strength. The company maintains a solid liquidity position. Historically, revenue growth has been steady, in the mid-single digits. However, growth is accelerating due to interest rate volatility and the shift to electronic execution. Operating margins are expanding significantly as more trading volume shifts from voice brokers to the high-margin FinTech electronic platform. Operating leverage kicks in. BGC carries a moderate debt load, but interest coverage remains very comfortable. The free cash flow yield is highly attractive, sitting at around 6.5%. This supports a robust capital return program, including share repurchases and dividends. Despite the recent rally, BGC trades at a forward price-to-earnings ratio of approximately 11.5 times. This is a significant discount to pure-play electronic exchanges like CME Group or ICE. Their enterprise value multiple is around 8.5 times, highly attractive relative to the business's cash generation capability. This valuation leaves ample room for multiple expansion as the FinTech segment grows and the market re-rates BGC from a broker to an exchange operator. Our conviction level on BGC Group is high. We believe BGC is in the midst of a structural re-rating. The massive institutional accumulation aligns perfectly with our compelling fundamental narrative. The growth of the high-margin FinTech electronic platform is driving significant operating leverage. Furthermore, the FMX Futures Exchange represents a massive, asymmetric call option on future earnings. We view BGC as a premier growth at a reasonable price play within the financial sector. We recommend aggressive accumulation, particularly on any minor pullbacks. While the upside potential for BGC is massive, it's crucial to acknowledge the risks. One structural risk is the Howard Lutnick control discount. Chairman and CEO Howard Lutnick maintains tight voting control through supervoting Class B shares. Some institutional investors historically avoid the stock due to this dual-class structure and past corporate complexity. Another significant risk is CME Group's defensive response. CME has massive financial resources. If they aggressively cut transaction fees, it could spark a margin-eroding price war. There's also integration and scale friction. While cash treasury market share is proven at 41%, futures liquidity can be a stickier habit to break. If open interest in FMX SOFR futures plateaus, the growth narrative could slow down. Finally, a broader bear case exists. If global central banks enter a prolonged period of synchronized low volatility easing, this could cause wholesale trading volumes to collapse, impacting BGC's revenue. So what's the bottom line for BGC Group? If the market broadening trade survives FOMC week, BGC may be one of the cleanest ways to play financial sector momentum. You get exposure to a highly cash-generative, asset-light business. It's riding a massive macro tailwind of higher global interest rates and market volatility. This natively drives higher trading volumes in fixed income. If FMX can convert even 15–20% of the U.S. futures market using its LCH cross-margining advantage, BGC has a clear path to both earnings growth and a significant valuation re-rating. This stock offers a compelling blend of value, growth, and disruptive potential in the often overlooked financial infrastructure space. Make sure to do your own due diligence, but BGC is definitely one to watch closely. What are your thoughts on BGC? Let us know in the comments below. Don't forget to like this video and subscribe for more in-depth financial analysis.